Hey, everybody. I hope you are having a wonderful week. We are excited to talk about reverse 1031 exchanges today. This is actually a topic we have never covered before, and a lot of people don't even realize that this is actually a thing. And so we are so excited to talk about it today. Of course, we love anytime that Luann and Dan get on with us because they're a wealth of knowledge. So thank you guys both for being here today.
Thank you. Hi, everybody.
So before we get started, quick disclaimer as usual, everything we're going to talk about today are the best guidance, judgment, and information based on years of experience from us as property managers, rental investor owners, and dealing in 1031 exchanges, and then from Dan and Luann and their years of what they do working with 1031 exchanges. Nothing that we're talking about today is legal advice or tax advice, and so specifically as this pertains to tax deferment, we certainly want to make sure that you go to those experts in your life that you trust for your tax consulting and advice before implementing any strategy. Make sure how it works for you and that it is the investment strategy that you want to use. But of course, we are always here for your questions. There are no crystal balls, but we will always do our best to guide you, to educate you. And certainly that is what our goal is here today as well. So without further ado, you guys take it away.
Okay, everybody, good afternoon, I guess. This is Luann, and I'm going to start. And then Dan is the reverse exchange expert extraordinaire, so I'm going to turn it over to him. But we're just going to, you've been on this, you might have heard some of this before, but the Section 1031 has been a cornerstone of the revenue code for taxpayers since 1921. So next year would be 100 years, and we want to keep it that way. And what it does, it was originally formed to, and it still does, transform sales that would have been taxable, long-term capital gain and depreciation recapture, into deferred non-taxable exchanges where you can purchase more property. So with the 1031 exchange, you can defer. If you decide to cash out, then you will have to have a taxable event. If you decide to defer until you die and pass your properties on to your heirs, at this point, your heirs will inherit the property at what we call a stepped up basis, which will mean the tax will go away permanently. So the 1031 exchange encourages real estate and economic activity. It encourages people to buy and sell and increase your portfolio and your passive income. And you will have, as an exchanger, will have increased cash flow and a greater ability to build your wealth. Next slide, please. Okay, so real quick, what is a 1031 exchange? It's pursuant to an agreement, the taxpayer transfers property held for productive use in trade or business or for investment and subsequently receives property to be held either for productive use in trade or business or for investment. So it basically means you can sell something defined as real estate and you can exchange it for something defined as real estate. It doesn't have to be single family to single family. It can be land to single family. It can be single family to multifamily. And it can be from any state in the US to any other state in the US, including Guam and the Virgin Islands. If you own property outside of the US, then you will have to buy something out of the US. So how much do you have to reinvest to do a 1031 exchange? You have to reinvest your net equity and your debt. So basically the amount of any note payoff plus the amount of cash you're going to receive at closing, which will go to the exchange, and reinvest that into like-kind real property. Dan, I'm going to let you explain the numbers and take it from here.
Sure. Quite frankly, we always talk about capital gains, but there are a number of taxes that you're deferring. Number one is the depreciation recapture, and that's at a 25% rate. Capital gains right now, depending on your income tax return, will either be 15% to 20%. I realize we're talking to a lot of people in Texas, and so you have a zero in state income tax, but there also might be a couple on the line from California where you have in excess of 13% state capital gains tax in addition to the federal rate. The 15 to 20 is the federal rate. And then depending again on your income tax, you'd have the net income tax investment, AKA Medicare. I normally call it the Obamacare charge, which is another 3.8% of your gain. So the reality is that 1031 allows you to defer a substantial amount of gain. And the little note is Pennsylvania is the only state which doesn't apply 1031 to their state income tax, but that's pretty de minimis. Next slide, please.
And just as we go through, as a reminder, if you have questions as we go, you can put those in the question dialog box on the right, and then we'll also have a question section at the end as well.
Yeah, and we'll be more than glad to answer any questions. And if we can't answer them today, we'll give you our phone number. Pick up the phone, give me a call, and we'll try to answer that question for you.
Yeah,
So,
but you're going hunting tomorrow, so there you go.
But there'll be somebody here at the office who can answer your questions for you. Yeah.
I can answer them.
All right. Any U.S. taxpayer can do a 1031. And when we say taxpayer, we don't necessarily, it's not necessarily an individual. It's any person or entity that has a tax ID number. Most of us have a social, but if you have an entity with a tax ID number, it's considered a separate taxpayer. You're always relinquishing one or more assets, and you're acquiring one or more assets. And again, like kind means real estate is real estate is real estate. And in most of the West, things like gas and oil are real estate. So you could sell a single family residence and buy a gas and oil interest. My wife and I have done that. At the end of the day, at the end of your tax return, when you've done your exchange, you simply report it to the federal government by filing a one-page form called an 8824. So the reason for that is that at the time you close on your sale, the IRS receives from the title company or attorney that closed the transaction a 1099 that says, hey, taxpayer received $450,000 on the sale of this property, a combination of cash and debt relief. And so that goes into the big computer out in the middle of the Utah desert someplace under your social or your tax ID number. And then when you file the 8824, that just tells the big computer, hey, ignore that $450,000 because look at they bought another property. And obviously, if you don't file that 8824, then the big computer is going to kick that out to somebody to look at that says, hey, Joe didn't buy another piece of property, so he needs to pay taxes on this $450,000. That's, as a practical matter, how it works. All right, a QI is required. As a practical matter, anyone who is not your agent or not a family member can serve as your qualified intermediary. It is required under the statute. We believe it's best to involve somebody like ourselves, preferably ourselves, being selfish. But as a practical matter, you want the correct documentation, you want the correct consulting, and you absolutely want security of the funds. And we take significant steps to make sure all three of those things happen. What we do is we obviously guide you through the transactions. That's what we're here for. That's what Luann's here for. We'll walk you through and make sure you understand it. We do all the required documentation so that the IRS ever does come knocking. You've got all the documentation that they expect to see. And as a practical matter, we have an arrangement with a bank that you contract with the bank. It goes into an account that's held in your name. Funds cannot be moved without your written consent. It's as safe as we know how to make it. And obviously, at the end of the day, that's always very, very important. That the security of client funds is our primary objective. All right. Again, we think that your account needs to be segregated. It needs to be signature locked, and it not be commingled with anyone else's account, including the QI's account. We will stand behind you in IRS review, make documents available, though I have to admit, in 25 years, I have yet to have to sit down with the IRS and walk them through this, but we have made documents available for clients. We probably need to update that, probably 90 plus years of experience. Probably more than that, but maybe we need to go back and address it. And our purpose here is to bring you to the comfort level that you understand what's going on and that you're comfortable going forward. And we're going to work with your professionals, be it your CPA or your attorney, your realtor, obviously, to make the transaction happen and make it happen in a manner that is most user-friendly to you. All right, let's talk about the reverse. If you can imagine this, essentially what you're doing with a reverse is you're going to go out and capture in advance of your sale the new property you wish to purchase. Everybody knows the market is abnormally hot. On the way in this morning, I was listening to the radio talk show host was saying that the average time on market in the Denver market, which is where I live right now, is 5 days. That's unbelievable. And quite frankly, a little scary if you're out there looking for a new piece of property. So what the reverse does is it allows you to capture that new one before you sell the old one. In addition, under certain conditions, you can also make improvements to that property that you purchase, be it cosmetic surgery, be it a major structural repair, whatever. You can make improvements to it, and we'll talk about that a little bit more. Or you can do new construction. And let me just compare and contrast those two. Probably the largest make improvements we've ever done was the IBM World Headquarters back in New York City. That was $137 million. But IBM needed a new world headquarters. They needed to not shut down IBM while I sold the old building and rehabbed a new one. So we did a reverse exchange. We went in. They completely rehabbed the new one. All we do is sign the checks. We then transferred it to them when they on the sale of their old one, and in a 3-day weekend, they literally moved all their employees into their new building. So that's the most graphic one, though most of them are much smaller than that. The new build, most recent one I've done is we just finished a multi-million-dollar car wash in Naples, Florida. You can't do anything in Naples that isn't a multi-million-dollar deal. But as a practical matter, we were able to get that completed. Now, the problem with the new build is you've got 180 days under the revenue procedure. And all these reverse exchanges operate under what is known as RevProc, or Revenue Procedure 2037. I was either blessed or cursed, depending on how you look at it, to go back and work in 2000 with the Internal Revenue Service to draft this. As usual with the federal government, they came out just a little bit different than what we talked about. But the limitation is 180 days. And so that's generally the limitation with new build. If it isn't either in progress or the governmental portion of it isn't completed, i.e. all the permits are in place, then it's difficult to do in that 180-day time period. Next slide, please. Why do we utilize a reverse exchange? Because the statutes are very specific. A exchanger cannot apply 1031 proceeds to a property they already own. In other words, you can't buy the new one, sell the old one, and pay off the mortgage. That's not allowed. And so that's what creates a 1031 reverse. It allows you to acquire a desirable property no matter what the market conditions might be. It allows you to create something that doesn't exist, and we'll talk about this, Texaco into a Starbucks, which literally is located, I walked by it last night, it's located about 6 blocks from my house. And last but not least, it allows you to take advantage of an unexpected opportunity. You know, the perfect property all of a sudden becomes available, you want to move on it, you haven't got your old one ready to go yet, the reverse exchange will allow you to purchase the new one before you sell the old one.
Hey,
All
Dan,
right. Yes, ma'am.
Dan, can you go into a little bit about the rehab issue and why the reverse exchange works for that too? Because we get a lot of questions from people wanting to buy property that need a lot of work. And,
Sure.
and the reverse is the way to do that as well. But can you kind of touch on that?
Absolutely. Let's with that in mind, let's look at this middle one here, Texaco to Starbucks. There was a primo corner, no other way to describe it, on the corner of Kipling and Florida, just two major streets here in Denver, that had been a service station for years. And that building, and of course all the that goes with the service station, tanks and pumps and all that type of stuff, needed to be modified. And so we did a reverse exchange. The client, my recollection was the client fronted all the cash on that one. We bought the old Texaco station, tore out the tanks, remodeled the building, leased it, converted it into a coffee shop, drive-through coffee shop, so the gas station had enough space that was a primary objective, that it be a drive-through, and converted it into a Starbucks location. About 3 years after they did all of this, the client subsequently sold it to a trust from Seattle, Washington, which I understand is owned by the same people who were the majority interest holder in Starbucks. But we were able to convert a prime piece of property because of its location and its size from one use, service station, gas station, to another use, coffee distribution center. And the client had another piece of property which they sold, and we ultimately flipped back into this, and therefore we're able to take advantage of the size of that location and the location itself, which was the real value in that particular transaction. So I'm going to talk about reverses exchanges generically, but there are so many scenarios that this vehicle can fit that it's almost impossible to describe them all. Okay, next slide.
I've actually got a stack of questions I'd like to go through. So
Sure.
One question, going back just a little bit, what does Pennsylvania charge when a 1031 is done?
What does Pennsylvania charge?
Yeah, I think they're talking about how
They don't charge anything. Pennsylvania is the only state. Every other state allows you to defer your state tax at the time of the sale. Pennsylvania does not. So there's a.
Go ahead.
Pennsylvania would charge a capital gains tax at the time of sale.
And then I have another question here, and I'm not going to read it verbatim, but essentially the question is asking how you exchange from single family properties to multifamily properties. Those are like for like properties, so you can go from single family to multifamily, single family to commercial, multifamily to single family. It's all the same in the eyes of a 1031. Anything that you all want to add to that?
The important thing to realize here, Leah, is that anything the state in which it's located defines as real estate qualifies for 1031.
Yep.
The other thing to remember when you're doing that is you have to keep the taxpayer ID the same on the sale and the buy. So sometimes when you're transitioning to multifamily, there might be a little bit of an issue with that, but we can walk you through how to do that.
Yeah, and what we typically do, if somebody still owns Fannie Mae in their personal name and they're going into multifamily, and you're doing a portfolio loan anyway, so you might as well put it in an entity, you'll close it in the name of the personal name with an agreement with the bank that they'll transfer it to the company after closing. So very simple to navigate that as well. And then, of course, most of you all know I've been a huge anti-proponent of Fannie Mae and conventional financing. So the majority of our customers are not using that. And so if you are using that, there's ways to get around it in the future if you choose to go into a company name as well. Now, here's another question.
We like to use there are alternatives, not my marketing people have said, don't use that term ways to get around it, because I used to say that too. We have an attractive alternative to curing that problem.
Absolutely. Absolutely.
Creative opportunities.
Well, and you know, it's interesting. A lot of people still try to just deed the properties over, and we won't ever do that. You know, the banks that we work with and the portfolio lenders we work with, they recognize that you're going to have to change title. And so when we have these 1031 issues, we just deal with it on the front end. I personally have had to do it. I even had an apartment that I bought a few months ago, and I completely flaked, and I created the entity for the project because it was a high risk project. I had it ready to go, and sure as can be, I put it in the name of another one of my companies, and it wasn't until I got to closing that I realized I had done it. And so, you know, we can all with 2020 recognize that we're going to forget little steps here or there as buyers. And so there's lots of things that we can do. And then sometimes it's just a fact that we're in a Fannie Mae property, it's in our personal name. So if you're in that situation, and especially if we're assisting you with the sale on the 1031, we'll help you walk through that with the lender to make sure that we have that figured out for you.
And we will double check you on title.
Yep, absolutely. So next question, what happens if the current property doesn't sell in 180 days? Do you lose the benefits of the reverse 1031 exchange?
Interesting you should ask that question, because what we're talking about here today is what we commonly call a forward exchange. And I'm going to tell you a quick story because that's kind of the way I teach. I have a client who I've done a number of transactions for over the years, and he wanted to buy a shopping center, and he had two buildings he wanted to sell. One was an 80-unit apartment complex, and the other one was a building he'd originally built for a savings and loan, a bank building. And so we got him connected with a bank. They loaned him 100% on the shopping center, and we closed on that in a reverse exchange. And then, boom, within about 60 days, the apartment building was gone, and that netted a couple of $1 million, and we paid down the loan with that. But the bank building was under contract to another company that was going to use it as a brewery. And don't forget, we live in Denver, so they're all over. But they kept running into snags with the city of Denver and with their building permit process. So we were rapidly approaching the 180th day, and so we did, and we don't do these often, but we did what we call a backwards exchange, where the client, we set up another entity, the client sold that property to the entity, got $1 million, paid down his bank loan, and then that entity held that property for about another 120 days, and then sold it to the ultimate buyer who was already under contract, because they got through the permitting process in the city of Denver. So if you get at the day 170 and you don't have things done, then we have another conversation. But what we're going to talk about today basically is a forward reverse, which is 95% of our transactions in reverse exchanges are forward reverses. We're buying the new property. There are a few which, for other reasons, require a backwards reverse, where we literally buy the old property in the reverse. And occasionally we meld the two of those together to take that 180 days out further. So that's the answer to that question.
And then last question is, how are taxes affected if your 180 days spans over December 31st, so you close in the following year?
Very simple. They're not. You just don't file your example. You wouldn't file your 2020 taxes. If necessary, if it's after April 15th, you take an extension. It's pretty common. All right. The actual mechanics of doing a 1031 reverse. We enter into an agreement with you after we discuss financing options and methods. All right. Approximately 60%, ballpark number, of our deals are entirely client financed, and about 40% of them are part of the client's money and part lender's money. So I spend a lot of my time dealing with lenders. Literally just finished one yesterday, walking a vice president of a local bank through how to do it. I love Texas because they've got so many small individual banks, and those people are willing to listen. I will tell you right now that if you're dealing with one of the big, Chase or Wells or those types of folks, they're not very conducive to thinking outside of their three-ring binder. So you're probably best off, if you need financing, dealing with a smaller, more local, more entrepreneurial banking institution, and preferably one where you might have some history. Okay, we're going to review the IRS rules and regulations so that you know going in exactly what you're confronted with and exactly what you can expect upcoming. Then, because you cannot put 1031 money into property you already own, we establish a limited liability company for your transaction and your transaction alone. So we're going to call it 123 North 2nd Street, okay? And we're going to establish 123 North 2nd Street Investment LLC, and it is going to purchase your new property. We call that a parked property because that's essentially what we're doing. We're parking it. That LLC is always formed in the state where the property is located. And if there's a bank loan, it is always in the name of the limited liability company with the client as a guarantor, and usually a provision in the loan that says the client can assume the loan at any point in time. And on occasion, the bank will want to go back and secure another piece of property the client might own, and we simply work out with the bank that you can do that as long as you're willing to release that security just before that old property is sold. And I won't go into why that's necessary. It just is in order to make all the numbers work properly. And lenders are willing to do that. The guy yesterday said, "Oh, sure, I understand why you want to do that. That's no problem. 10 days before you close, we'll release our security interest in that additional piece of property that's outside of the scope of what we're doing right now." So that's essentially how it happens. Next slide, please. Then the EAT, the EAT is the Exchange Accommodation Title Holder. That's the Internal Revenue Service's name for this limited liability company. Closes on the property. We then enter into an agreement with you that does one of two things. It either leases that property back to you, or it makes you the construction manager of that property, or both, whichever applies in your particular situation. And if we lease it back to you and there's a bank loan on it, the lease payment is that simply you service that debt. So you have complete control of that property. You can collect the rents, you pay the underlying debt, you provide the insurance coverage as part of the lease, and to be honest, the vast majority of these projects we never even see because all the management is done by you. So other than the fact that you, the exchanger, don't legally own the property, you control all the other aspects of the property. And our agreement has a provision in it that you have the exclusive option to purchase the property. So it's not going anywhere. You have it under lease, you have the exclusive option to purchase it. And we are owners of it only for taxation purposes, for all intents and purposes. Okay. At a later date, you sell the old property or properties, and we've had some that, well, I had one recently that was a rather large ranch that 7 different properties came into. Okay, it was a $2.8 million ranch, and the client sold 7 different properties to make that move. And so that's a normal 1031. From the IRS's point of view, you're selling the old and you're going to buy the new. They will probably not even realize that you already control the new. So the cash from your sale flows to us. We have a conversation. I say, all right, how do you want to do this? And you say, well, I owe the bank 400,000, but I put up 100 grand and we got 300,000 sitting there. Would you please send me my 100,000 and apply the other 200,000 to the bank? Certainly, we'll do exactly that. And we do that. And then we show that on a settlement statement, and we transfer, we call it a flip, of the ownership of the EAT back to you. And the IRS has ruled that transfer of an LLC that owns nothing but real estate is the equivalent to deeding the real estate, which is only logical. So we transfer that EAT back to you with an assignment of interest. You contact the Secretary of State's office, change the registered agent to yourself, change the address to wherever you office out of, and for all intents and purposes, you then go forward with You can leave it in that EAT. You can change it to another LLC if you wish to do that. But you now own the EAT, and you can do with it as you please. And
So I've got
a quick
question.
example, let's kind of picture this settlement statement. Assuming that it's a $500,000 buy, you put up 100, the bank put up 400, we now have 300 out of your old one. We pay you back your 100, we pay 200 down to the bank. You take the EAT subject to, and it's on the settlement statement there, subject to that 200,000 still owing to the First Bank of Houston, or whatever it might be. And since you're already the guarantor on the loan, and the loan is in the name of the EAT, and you now own the EAT, you just keep making your payments except at the reduced amount. And then realistically, you probably go in and renegotiate so that those payments fit the amount you owe, not the amount you originally borrowed. Next slide, please.
So I have a question.
Okay.
What she writes is this process valuable to a small timer? As in, we buy houses for less than 100,000, we renovate them, rent them for a period, then sell for a gain of $30,000. Talking no more than 1 to 3 properties a year.
And that's a chat we have with each individual transaction, because what we want to do is weigh and measure whether or not the tax savings are sufficient to justify the cost of the reverse exchange. And so, you know, until we know exactly what the numbers are, that would be difficult to do. But, you know, if you have an income of 30,000 and you have a tax rate of 20%, that's $6,000 in rough numbers. Okay, so as a practical matter, a reverse exchange may not fit for you because a reverse exchange is going to cost you somewhere in the $4,500 to $5,000 ballpark. But if you've held a property for a period of time and you've now got a $100,000 gain and a $20,000 tax bill, then it's a no-brainer because it's worth, you know, spending $5,000 to save $20,000. So that's an analysis we usually walk through with each transaction that we do, and we're very open about it. I've told some people it's my opinion that this may not work for you, or if it is, it's a push, and so that's a decision you can make it. I'll never try to make that decision for you. I just give you information, and you know, we'll walk through the numbers and see where you're at. All right, improvement or construction exchange. Now, let's assume for the sake of argument that we're back to our original transaction where you're going to buy a property for $500,000, but the one that you're going to sell is $600,000. And so theoretically, you're going to have $100,000 more, but the property you're purchasing needs some pretty major improvements. And I'll just make something up, but the garage is in shambles, and the patio is cracked, and it needs cosmetic surgery. And so you could pretty easily spend $100,000 on this property. And so that's exactly what we do. We would borrow additional funds from you or additional funds from your lender. While the EAT owns the property, you oversee, contract with, and supervise those improvements. And at the end of the day, we then pay for those improvements. And at the end of the day, transfer the property back to you at its cost plus improvements. And let's just assume for the sake of this discussion that we hit that $100,000 figure. So we're going to transfer the property back to you at $600,000, which happens to coincide with the reinvestment goal from your 1031 exchange. And you've managed to put $1031 into a property that if you just bought it, you'd have $100,000 capital gains on your sale, and then you'd spend the money improving the property anyway. So it allows you to use those tax deferred dollars to improve, modify, enlarge an existing property while the EAT owns it, so that when it's transferred to you, its value is increased by the amount that you wish to increase it in order to meet your reinvestment goal. So we, once the established EAT is going forward, it either borrows new money from you or from your lender, If the exchange proceeds are available, those can be used. All right. And those can be used and invested in the new property. We make you the construction manager, enter into what we call a CMA, construction management agreement, so that you can go to the city or the county, wherever you have to, and sign on behalf of the EAT. Again, you're not the owner, you're just a construction manager. Get whatever, permitting is necessitated and required. You can go sign a contract with the contractor. Generally, in those types of things, the contractor will say, well, I need 30% or 50% down to get started, and you contact us and we forward a check in that amount. We pay the bills as you send them to us, and then copy you with a copy of the bill and a copy of the check that paid it. And at the end of the day, we do a settlement sheet that shows the draws, the payments that were made, the increase in value, the purchase price, and all the numbers are laid out there so that you can look at them and understand it. It's a phenomenal tool in the right circumstances. And those circumstances are arising more and more simply because they're being market dictated.
And it's only getting worse. Now, of course, those that are buying with us, we have plenty of inventory, but with your kind of regular market buyers that are out there finding deal to deal, it can be very difficult. And specifically if you're working in other areas of the country, I think this is used a lot more in the very dense markets that are so oversaturated right now with these high values than some of your smaller markets or your more diverse markets.
Absolutely, and this particularly gives your clients an opportunity to find some value-added properties and add that value with tax-deferred dollars. Okay, so the work begins. Each pays the bills as we're directed and approved by you. If you send it to me, we have a discussion that begins that if you send it to me, I'm going to assume you want me to pay it, and so we do exactly that, and then copy you back. And all the expenditures must be completed by day 180. And before that day or on that day, we transfer the EAT to you as your replacement property. So your time frame starts to run on the earlier of the sale of your old, which gives you 180 days on that transaction, or the purchase of the new, which gives you 180 days on that transaction. And we have had a few of them where we've had to piecemeal it, transfer a piece of it to you in advance because of the timing. A certificate of occupancy is not required by 1031, and you can continue work after the exchange ends. We're going to transfer the property to you before that 180th day with whatever money spent is spent now. As a practical matter, I'm sure I have paid for materials that have not yet been included in the building. I'm sure there's been windows or carpets or things paid for that might not yet have been installed, but I got the bill and we paid it within that 180-day time frame. We're always working within the time frames that are required by the Rev Proc, and those are the major limiting factor. Those time frames, always those are the major limiting factor. Okay, next slide, please. One of my favorite quotes: anyone may so arrange his affairs that his taxes shall be as low as possible. He's not bound to choose that pattern which will best pay the treasury. There's not even a patriotic duty to increase one's taxes. And that's former U.S. District Court Judge Learned Hand back in the 1903 case. So, using the tax law to your benefit is not even unpatriotic. It is simply smart business. I'll be glad to answer any more questions that you might have. Here's our contact information. Shoot us an email. We'll be more than glad to try to respond. Give us a call. We're here to make sure that you are comfortable moving forward. We'll deal with your realtor. We'll deal with your attorneys. We'll deal with your CPAs. From my point of view, it always helps when dealing with the attorneys if I say, been there, done that. Kind of like it's a secret handshake amongst those of us in the legal profession, and then they listen to me. But as a practical matter, it's a powerful, powerful tool. Think about what it might do for you. It's not for everyone, and it's not in every situation, but there are getting to be more and more situations where it's a mechanism that you want to apply to achieve your goal. I'll be glad to answer any questions anyone might have.
Let me throw a couple questions at you that I think might help some of our clients on here, because we've got a pretty big class today, understand what percentage you're doing of these. So compared to regular 1031s, I know you do a ton of those. Ballpark, how many of these reverse exchanges would you say you guys have done this year?
Oh gosh, this year. Oh, a couple hundred.
Okay, so this is not as rare as it sounds like it is. They can be an amazing tool, and I've heard a lot about them, and I'm hearing more and more as we go through this just insane market that we've walked into out of COVID. And so I think we're probably going to hear more and more about them. And I think that there is potential to use them, especially for those of you that are buying in other markets. If you are still actively buying in some of the very, very fast moving markets, which Dallas, yes, it's fast moving, but we have a unique investment list. So it doesn't affect us the way that it would elsewhere. But, Denver is a perfect example. Lots of parts of California, lots of parts of New York, parts of Florida. The market is very hot right now. And this is a tool that you can use in lieu of having to sell first and buy after. So, Dan, if somebody's trying to decide whether or not to use a reverse or whether to go the traditional method, what metrics would you want them to use to make that decision? What would your advice to them be on determining which option is best for them?
Well, that's a loaded question because there's multifaceted. Let me go back to the other question. I literally spend almost all my time on reverse exchanges, talking to people, doing the setups, forming the LLCs. So, take that into consideration. In our office, I spend almost all my time on reverse exchanges working with Ken as he gets a little more experience so that he can spend more and more of his time on it, where there are that many of them taking place. The metrics are a couple-fold. Obviously, number one, there's the economic metric. If your gain on the property is equivalent to the cost of doing the exchange, it may not make sense to you. But if your gain on the property, your tax gain, the taxable amount on the property is 5 times or 4 times or 3 times the cost of it, then maybe it makes a whale of a lot of sense. That's one metric. The other metric, and I'm finding it to be more and more of a factor, is I want it metric. I'm just finishing one up, or I'm just essentially finishing up a series of exchanges that brought us to a buy on behalf of a client in Jackson Hole, Wyoming. Jackson, Wyoming is the name of the town. Everybody knows it as Jackson Hole because that's the ski area. But it was a property that they wanted. We want it. And so let's move forward. And I'm willing to take whatever steps are necessary because that's the property I want. And that's I don't know how you measure that metric. But that desire metric is a very, very strong one. It's ideal. It fit their boat. It was where they wanted to be and where they wanted to spend the rest of their life. And so I'm willing to take whatever steps are necessary. Now, in addition to that, they'd held their other property for quite some time. So economically, it was a no-brainer. But that emotional factor is one that there's no way I can measure that. Only the client can measure that. But, I had one client a while back, quick story. Call me and say, and he's a fellow I had done some stuff with in the past, and he said, Dan, I need to buy this property. I need to buy it tomorrow. And I said, well, why? He says, because the next door neighbor wants it and he's got more money than God. And I said, I doubt that. Who's the next door neighbor? And he told me who the next door neighbor was. And I said, okay, he's in second place. But the next door neighbor owns a number of professional sports teams, a number of that you would instantaneously recognize, both here and abroad. Okay. So for him, it was, I've got a couple of rentals, I'll get them sold, but you got to be prepared to close on this property for me tomorrow. And we did, and he was successful in getting it. Ultimately, he did turn around and sell it to that neighbor because that neighbor just offered him another piece of adjacent property and stacked the coin so high he'd been a fool not to do it. But that opportunity would have been lost to him had he not been able to move forward very, very quickly. And at the time we purchased that, he didn't know for sure what he was going to buy. And I'll just point out that in the regulations, you're allowed 45 days to decide what you want to buy once you purchase in a reverse exchange. So it's not something you have to decide before you pull the trigger on the reverse. You've got 45 days to decide what you're going to sell. And you can list multiple properties in that sale, and you can sell multiple properties in that sale. So those are just some of the processes that you go through in attempting to arrive at the decision of whether or not a reverse exchange will be the vehicle that'll take you to the destination you want to go to.
And then tell me, how long does it take to set one up if someone decides they want to do this?
Generally, we'd like as much advance notice as possible. If we have 2 weeks, hallelujah. Have I done it in 2 hours? Yes. Is it more difficult in that short period of time? Yes. And basically that is because a number of states now, we're blessed to be in Colorado, and that Colorado is all instantaneous on the computer. But example, I just formed one in Washington, and it took the state of Washington 3 days to form it. You can do all these things online, but they make you wait a couple of days. Arizona is particularly troublesome.
What about Texas? Dan, isn't it 2 or 3 days?
Texas is a couple of days. Yeah. It's one of the more reasonable ones. So the issue there is that you have to have the EAT set up so that the title company can transfer the property to a recognized legal entity. But the people in the last one in Washington had about a week. We were able to get it set up. We're ready to go. So it isn't often, with the possible exception of Arizona, that we run into snags, but it's doable. And of course, the states are catching on. If you want to speed that process up, they just charge you more.
And you
Arizona, we'll tell you 30 days, and then if you want to speed it up, then just pay another $300.
And you get to pick your own name,
yeah,
so that when you do get it transferred back to you, that you'll have a name that you like.
We generally use the name of the property, the address of the property. But if you have a burning desire to own something in a specific name and it's available in your state, that's doable.
Perfect. Well, you guys have been great as always, and I thank you again for joining us. And if anyone has any follow-up questions, you've got both of their information here. And of course, everybody by now knows how to reach me. So I figured I'd let them have the spotlight today. So everybody have a fantastic rest of your week. We've got our exclusive investor class, I believe, tomorrow. And then we've got just every week, fantastic classes coming up over lots of great topics. And then we are going to have a post-election class coming up where hopefully I'm going to be telling you about how 1031s are not at stake. But we will go over whatever happens November 3rd and how we expect it's going to affect the next 12 months. So as always,
Lee, you're being an optimist. It's not going to be over on the 3rd.
I don't know. The polls coming out today are looking like it might be, but we'll see. I'm going to keep it political.
As an old attorney, I'm telling you, they're not going to be able to keep their fingers out of it. They're going to have to generate some billable hours. So it's not going to be over on the 3rd.
All I can tell you is in this case, everybody loses. What a year it's been. We are almost to November, and like 2020, we're at the tail end. So that's the best that we can hope for at this point.
You're so true. So true.
Well, again, thank you guys. Thank you everyone for being here. And we will look forward to seeing you later this week for the property class. And then again next week for our next educational one. Stay safe, everyone. Have a wonderful weekend, and we'll see you next week.
Thank you. Bye.